Hello, good evening, everyone. Welcome to all of you for today's session. Students, we are doing practice questions on the topic, which is investment appraisal. We will continue the practice questions. And this is the question in front of you. Comment, calculate, and comment on the Coeden company's cost of equity. Its cost of equity. Comment on that. And then the second point, they said that current and weighted average cost of cost of equity and weighted average cost of capital before and after implementing the proposal. State any assumptions made. 16 marks. Discuss the validity of assumptions that market value of equity will remain unchanged after the implementation of proposal. So 4 marks it has. So this is the question in front of you. And you may have gone through the scenario as well, a bit of it. Question number 33. So let me arrange the Excel sheet along with it so that we can yes. Now, so students, the question is cost of equity and WACC before and after implementing proposal. State any assumptions you made. Right? Coeden Company is a listed company operating in the hospitality and leisure industry. Coeden Company board of directors met recently to discuss a new strategy for the business. The proposal put forward was to sell all hotel properties that Coeden Company owns and rent them back on a long-term rental agreement. Coeden would focus solely on the provision of hotel services at these properties under its popular brand name. The proposal stated that the funds raised from the sale of the hotel properties would be used to pay off 70% 70% outstanding non-current liabilities, and remaining funds would be retained for future investments. The board of directors are of the opinion that reducing the level of debt in Coeden Company will reduce the company's risk and therefore its cost of capital. If the proposal is undertaken and Coeden Company focuses exclusively on the provision of hotel services, it can assume that current market value of equity will remain unchanged after implementing the proposal. Okay, we will see. We will see. Okay, now. So this is the assets, and these are the non-current liabilities which they want to redeem. Okay, now. Coeden Company's free cash flow to equity of this was estimated into after taking into account tax, interest, and reinvestment in asset to continue with the current level of business. It can be assumed that annual reinvestment in asset is required to continue. The current level of business is equivalent to annual amount of depreciation. Over the past few years, Coeden has consistently used 40% of its cash flows to equity. Friends, do you enjoy reading it? You should enjoy. They have consistently used 40% of free cash flow to equity on new investment, and they distribute 60%. The market value of equity calculated on the basis of free cash flow to equity provide a reasonable estimate of the current market value of Coeden company. Now, so we can calculate the market value of Coeden company. The bonds are redeemable at par in 3 years' time and pay the coupon on the annual basis, although bonds are not traded. It is estimated that Coeden company's current debt credit rating is triple B, but would improve to A plus if the non-current liabilities are reduced by 70%. Current equity beta, the current cost of equity. Stick to the requirement. Equity. We need to calculate. Current equity beta, 1.1. Risk-free rate is 4%. And market risk premium is 6%. So 4% plus 1.1 into 6%. So it is 10.6%. It is 10.6%. Current cost of equity. Now they said calculate current WACC as well. And in order to calculate WACC, what we need? What we need? Visualize. We need its current share capital market value. We need its non-current liabilities market value and their cost. Also, market value of all sources of capital. We need cost of all sources of finance. What do we need to calculate WACC? So current cost of equity is we have calculated using the capital asset pricing model. Current. Now, so market value of equity, that is not given. Yes, they have given further information to us. The bonds carried rating is, so we need market value of equity. We need that. So there is no beta available for companies offering just hotel services since most companies own their own buildings. The average asset beta for property companies have been estimated at 0.4. It was estimated that hotel service, this is after implementation of proposal, these things will vary. Okay. Now, Coeden companies corporation tax is this. 3-year bond borrowing spread on A plus rated bond is 60 basis point and 90 basis point on the triple B bond over the risk-free rate. Now, so cost of debt, what will be that? The company's bonds are currently triple B rated. They say 90 basis points over the risk-free rate. Risk-free rate is 4%. Plus 0.9%, 90 basis points. This is pre-tax cost of debt of the bond. This is pre-tax cost of debt of the bond. Now, the next is market value of bond we need to calculate. We can calculate. It is 5.2%. It is 5.2% redeemable bond. Now, they say redeemable bond, 5.2%. In how much time it has to be redeemed? In 3 years' time. Coupon on annual basis. Okay, so we have to draw the cash flows of the bond. Yes. So cash flows of bond. Just see here. 0, 1, 2, 3. We need market value. So market value of any bond which is redeemable or convertible. The market value of bond is calculated present value of its cash flows discounted at its pre-tax cost of debt. It is calculated like that. So cost of the, so you see here, what are the cash flows of the bond? 5.2% every year. It is, yes, paid on the bonds, redeemable bond. Now, so 5.2% is the coupon annually paid. It means annual interest payment. This, and they say it is redeemable at, it is redeemable at par plus 100. Redemption value in the final year. These are the cash flows of the bond. So present value at the rate of 4.9%. Present value, I told you, pre-tax cost of debt equal to this into 1 plus discount rate is 4.9%, 0.049 raised to par minus this is present value of cash flows of the bond. Now, the next point is simple as that. So present value of cash flows. This is market value per bond. That is equal to market value per bond. Yes. So how many market value of total bonds? Just see here. They say 42,000, 3-digit round off. Okay. So 42,000, sorry, divided by 100 into this. 100 divided, it is number of bonds. This is 3-digit round off. Market value of bonds is in front of you. Yes. So total market value of bond is in front of you. Now, market value of equity. They have given us all that data here. They've given all the data. That free cash flows to equity. Okay. That will be used to calculate market value of equity. How? So we know that market value of equity can be calculated at present value of free cash flow to equity at the rate of cost of equity, discounted at cost of equity. They have given us G. This is, they have consistently used 40% of free cash, and G, we know that G is equal to BR, the formula to calculate growth. Okay. So the first assumption is this formula provides a good estimate of the Growth rate, the first assumption. He said straight assumption as well. So B, how much they are retaining? 40%. So R is the cost of equity here. Cost of equity here. Return on equity. Here it is. So G can be calculated. This G is growth of cash flows, 4.24%. 4.24%. Now, then they say that these are the free cash flow to equity, 2,600. So present value, market value of equity. That is equal to 2,600 into 1 plus G divided by cost of equity. It is perpetuity with growth formula. R minus G, or cost of equity minus G. 3-digit round off. Once again, you can see the formula. If there is a confusion, you can ask, please. Now, so market value of equity, we have calculated. Market value of bonds, we have calculated. Cost of debt, we have calculated. Cost of equity, we have calculated. So current WACC, we can calculate. We can calculate how? How to calculate current WACC? Yes. How to calculate? Students, here capital, amount, yes, cost, and weighted average. First of all, equity. Equity capital. Debt. Debt capital. Here it is. By chance, it is almost same. You can see near to each other. Cost of equity is here. Cost of debt. Cost of debt is equal to this into 1 minus tax rate. Cost of debt is tax deductible. 20% tax rate, 0.2. Cost of debt is tax deductible. Yes. So it is tax deductible. Now, weighted average. This plus this. So weighted average is equity divided by total capital into this. Debt divided by total capital into this. So this is called WACC. .27% WACC. Before implementing the proposal. Now we will talk about the proposal. If there is any confusion in any point, you can ask before I proceed. Now, students, the company is in hospitality and layer. The proposal is that they will sell a hotel and they will stay in the hotel and rent them back on long-term agreement. Then they will provide provision of hotel services. So they will be managing only hotel services. Okay, properties they will sell. So it means the proposal is that they will leave the properties, they will concentrate hotel services business. So proposal, the company will leave property management, rather focus only hotel services business. So which beta will be implement? Now beta, as beta of hotel services is needed. So they say that there is no beta available for companies offering hotel services, since most of the company own their own building. Average asset beta for property company, property business, asset beta is 0.4. It has been estimated that hotel service business account for 60% of current value of Coeden, and property business is 640%. So asset beta of Coeden company is equal to 60% of asset beta of which business? Hotel business, plus 40% into asset beta of property. Okay, we have asset beta of property. What we want asset beta of hotel. We can get this from the given data because current equity beta is 1.1. So we can write here asset beta of Coeden company before proposal. So if you remember the formula of uh, asset beta and that equity beta relationship, do you remember that? How many of you remember? Yes. How many of you remember that? Tell me that formula. Students, although the formula will be provided to you in the formula sheet, but I want you to memorize majority of the formulas for swift, processing of your write-up in the exam. Otherwise, you will face time management, yes, issue. You will face that. So now the point is, if you do not remember that, the formula, I will write that in front of you. Yes, just a minute. I'm writing. It will appear in front of you. It takes few seconds. Beta asset is equal to beta equity. This is the formula. It's just going to appear in front of you in few seconds. It is taking this first. Yes, this is the formula. So beta asset we need. So beta equity of Coeden company is 1.1 into market value of equity. We have calculated of Coeden company divided by, sorry, now it's okay. It's okay now. Can you see that? Thank you. Thank you. Thank you. So you see here, once again, applying this formula, beta asset we need to calculate. Beta equity of Coeden company 1.1 into E is market value of equity of Coeden company. This divided by again market value of equity plus now market value of debt into 1 minus tax rate. Tax rate is 20%, 0.2. That is the beta asset. So we have got the answer of this. So this equation. So the equation will be 0.613 is equal to, yes, 60% into beta asset of hotel business plus 40% of beta asset of property business, which is 0.4. Now we can get beta asset of hotel business very easily now. So beta asset of hotel business, that is equal to, just see here, 0.613 minus 40% into 0.4 divided by 0.6. I just rearrange this equation. This is the beta asset of hotel business. 0.75. If there is any confusion, any question, you can ask. Now, this is beta asset. Now re-gearing it for, yeah. But we need to know what will be the hotel only services. So market value of equity, they said, remain the same. They said that in the question, that after implementation of proposal, equity, current, and even after proposal, I read it somewhere. Yes, here it is. will remain unchanged. So market value of equity is the same. What about debt? What about debt? Debt market value will change. Why? Because cost of debt will change. They said that rating will improve and will become on A plus. So cost of debt, that will be cost of that debt, that will be 4% plus 0.6%, 60 basis point. Rating improved. Hence, we can say this whole cost of debt calculation will change. I will simply copy. Just a minute, please. I will simply copy it. This calculation. Now, Excel, you will have the same facility in exam. Okay, don't you worry. So what I have to do is present value at the rate of 4.6% and 0.46. That's it. So the market value of bond is changed. Total bond value changed. Okay. And now this is 70% of the bond will be repaid. Since 70% of the bond will be repaid, remaining bonds will be, market value will be this into 30%. Yes, 30%. So this is the bond market value, not this one. Relevant. Market value of equity is here. Cost of debt is here. We need cost of equity, remember. You see how much in reverse working we have to do in order to re-gear this beta asset. Now focus everyone. Now focus everyone. So please, re-gearing beta asset of the hotel services. Now this formula will be rearranged. The formula we wrote. We need now beta equity. So the formula will become like this. Beta equity is equal to beta asset it will become like this. Yes, re-gearing it. So re-gearing it. Beta asset into equity market value plus debt market value into 1 minus tax rate divided by equity market value. Once again, applying this formula. Sorry, there is some mistake. Just a minute, please. 1, 2, 3. Yes, there is mistake. B41 beta assets into B47 equity plus debt into 1 minus t. Right now, yes, now it's good. 0.927. So we got beta equity. So hence beta equity, that is equal to 0.928. We can calculate cost of equity revised. Risk-free rate is 4%. Risk-free rate is 4% and equity risk premium 6%. 4% plus beta equity into 6%. So 9, this is the revised cost. And now we have to calculate revised WACC. I will give an overview at the end again. I know a bit complex question it is. I know that. Okay, so don't you worry. So capital, cost, weighted average. So equity capital, debt capital, cost of equity is here, and cost of debt, this into 1 minus tax rate. Yes. Now, WACC, we are going to calculate. This divided by this into equal to this divided by this into so 8.2% is the WACC, 3%. Yes. Then they said calculate and comment and state any assumptions as well. So the assumptions which we have used, what are the assumptions we have used? Yes. So we have taken one assumption here at the start. G is equal to BR model. Yes. Right? So the assumption, we will write assumption here. Wherever you are using an assumption, you write here the assumption. Like this. What you will write? The estimated growth rate of free cash flow to equity can be calculated using G is equal to BR. Yes, BR. And assuming free cash flow to equity will grow till perpetuity at this rate. This is assumption. On this assumption, we did this calculation. Yes. At this rate. Yes. The second assumption is assumption. Student, this is the rule in AFM. It should have been written when I was doing calculation. So it should have been written at the same time. The second assumption is they are using average asset beta for property sector. Okay. Average asset beta of the property sector. Right. They're using that. here. Second, second assumption. One, average beta asset of property sector is the same applicable to the Coeden company property business. That is, let's come. That is, it it correctly reflects the business risk of Coeden company property business. Simple as that. Yes. And third assumption, the third assumption, when we made this equation, the total beta asset of reflecting risk of business risk of selecting business risk of Coeden company is weighted average of hotel industry and property industry beta assets, weighted average of that. Now, so three assumptions are there here. Now comment. Then read the requirements, break them down so that you can get proper marks. So, how to comment on that? We have to write before proposal or current, after the proposal, cost of equity, and WACC. So cost of equity. Yes, current. After the proposal. After the proposal. Here you go. WACC. After the proposal is here. And just a minute. Where is the WACC? My mistake. There is some calculation. Oh, what happened to this? Just a minute, please. Just a minute, please. There is something wrong happened. Okay. Yes. Yes. Now, the WACC is here. This divided by this into this into 1 minus tax rate. It is already tax rate. Yes. Yes. 8.2%. Yes. So then WACC before the proposal. Now, before commenting, I will give a quick overview. They said that current cost of equity, and they have twisted the question. I told, and current WACC. We need for the cost of equity and for the WACC certain data. Cost of equity data was straightforward given. We calculated that. Cost of debt, they have twisted a bit that the bond rating is currently triple B. So that we found that from the scenario again. But the market value of the bond we need to calculate. It is 5.2% bond. We calculated its present value of the bond cash flows at 4.9%. We got it. So hence total bond market value currently. Then equity market value. They have given us the data here, the free cash flows and retention rate, etc. as well. So we take some assumptions here, okay, and we calculated G is equal to BR. Okay, 40% is retention rate, cost of equity is equal to R. So we have done it. And market value of equity. Then we calculate simple WACC, current. Then the proposal was implemented that they will sell the property business, continue the hotel business. So property business asset beta is given. Total beta equity is given. So we want hotel services beta asset. So we developed an equation from our side based on given data. And hence, in order to calculate this asset beta, we have calculated, yes, we ungeared the asset beta of Coeden with the current capital and equity. Now we have to re-gear it. Revised capital we need to calculate. Revised capital. Market value of equity is same, but cost of debt is changed. So we calculated bond value, total bond value. 70% of bond will be repaid. So 30% will be remaining. So this and market value of equity and costs. Hence, WACC is there. So this is the summary. Now this summary is telling us something. Cost of equity is decreased. WACC is increased. Now, you see here. Cost of equity is decreased and WACC is increased. This is the point. How it is to be discussed. So then the point is, due to redemption of loan, 70% loan, risk for equity holders is decreased. Equity holders of Coeden company is decreased. So required rate of return in terms of cost of equity is also reduced. Got it? But in the capital structure, cheaper source of fund, that is debt capital. Debt capital. proportion is reduced. Proportion is reduced. And proportion of expensive source of capital, that is equity, increased. That is increased. Hence, overall WACC has increased. Overall WACC has increased. Now, so we have commented on that. Just a minute, please. So, student, this is done. Discussion is done. The reason, comments. Now, the next part is discuss the validity of assumption that market value of equity will remain unchanged. Yes, very good question. Student, this discussion will help you. Remember, you should broaden your canvas of thinking. And you know that this should help you. They said that value of equity will remain unchanged. How come? So it is the assumption that after the implementation of proposal to redeem loans and focusing on hotel business, market value of equity will remain the same. Which doesn't seem to be a sound assumption. As growth rate of business will change, business cash flows will change. As cash flows will not include the cash flows of property business. First of all, because we use that model, you see, to calculate market value of equity. Moreover, financial risk of the business is changed. Due to decrease in debt. Cost of equity calculated above based on that is decreased, and it should have been reflected as increase in market value of equity. Yes, it should have increased. That's it. So student, 2 points, 4 marks, valid points over here. Okay, so directly linked. Cost of equity is decreased because present value of free cash flows at lower cost of equity will be higher. Okay, will be higher. Done. Now the point is, what is the how professional marks are awarded? Student, use of data from scenario for to support discussions. Okay, we are utilizing that. We are discussing the information from the scenario. Okay, and we are challenging their assumptions. And how can you? This is called skepticism. That financial risk is reduced, but you are keeping the same. And then appropriate use of data for calculation. 1 professional marks for that. Okay, so that is how marks are awarded. You have not to write something additional for that. Okay, students. Now I intend that I will continue like this, additional sessions and practice questions. So I hope you will like that. Okay, so that's it for today. One question class it was. We have done it. Students, there is another question. Please see. This question you should try at home. This is on APV, adjusted present value. You should try it before next class. Okay, so APV, Boring Company. June 14 question. It is a good question. And I will continue. I'm telling you in advance. Okay, so thank you. God bless you. See you. Take care. Goodbye.